General Motors shares are trading at a record. That's after the company says it's expecting another year of strong financial performance. This comes as the automaker sees higher demand for SUVs and trucks and pulls back on its electric vehicle plans. Here's what the CFO told our Pras Subramanian earlier.
If you think about where we've been for the last few years, we were tooling up and scaling up to produce 1 million EVs a year because that's what the government was requiring under the prior administration. So with the changing regulatory environment, we see a much slower path to EV adoption, but we do see a path. As far as demand goes, I think it gives us time to get the charging infrastructure up and ultimately get people more accepting of EVs.
Joining me now, Tom Narayan, RBC Capital Markets lead equity analyst for Global Autos. Tom, it's great to see you. I do want to dig into that EV question, but first of all, just taking a look at this quarter, the buyback, the dividend increase, it seems like investors got kind of most of what they wanted here.
Yeah, I would agree with that. I think into the quarter, there's been a lot of negativity on autos, a lot of geopolitical questions and tariffs, et cetera. And some worries about U.S. sales. Would it be down next year and all of this? And so I think these results, first of all, just on their own, they were great. Make no mistake. But even beyond that, I do think there was some surprise factor to the positive. It's probably showing why there's an outsized positive performance.
Yeah, it seems that way with that 9% increase. I mean, the shares were already running up into this report, right? We've already seen some increases there. So what does this reaction imply about now what future expectations are for GM?
Yeah, I guess I was talking about just the past couple of months, how the stock was trading. But I think it's a very positive picture. We've been talking about this now for a little while now. We're very constructive on the U.S. auto market. We don't think a car is a consumer discretionary purchase. Unemployment is at record lows. GM is also specially positioned because they have like 60-70% of large SUVs and pickups. We know that the strength of the U.S. economy right now is on the higher end, right? Not on the lower end. That actually benefits GM. They're doing this big buyback. There are a lot of things also that came out on the conference call, which I think are important. A lot of people are worried about memory chips, right? And GM said, you know what, like, at least for now, things are okay, right? They put it in their kind of commodities bucket, and it wasn't even the biggest element there. And then the other big story is EVs, which I'm sure you're about to ask me about.
I am about to ask you about that, Tom. I thought it was really interesting that Jacobsen painted this as, well, the government was making us do it, as though there's no consumer demand. There is still some consumer demand for EVs. Do you think that GM has sort of right-sized or corrected the course for their EV strategy? Do you think they've done that properly?
I mean, I think they've really done a great job, honestly, in how they've structured their EV deployment. They were later, right, than, let's say, Ford, for example. They have plants that are flexible. That's really important, right? Because, you know, for example, at Orion, they just, instead of making electric pickup trucks or what have you, make more ICE pickup trucks. That is a huge luxury to be able to do. And then, you know, in Ramos, they're making the EV Equinox and Blazer, and they can just shift production to ICEs there. And so I think it's also a smart way they put together their EV strategy. They still believe in EVs, right? Longer term. You know, I've been saying this for a long time. We did a lot of work on this. I think one of the big reasons why there's an EV slowdown, sure, there's policy, but it's also like you can get really cheap used EVs right now. Why would you buy a new one, right? So there's a huge glut of, you know, leases from 3 years ago that are hitting the market, and you can get really cheap used EVs. I think that's a factor. There is EV demand. People do want these products. We'll get there, right? It's just right now, GM can very smartly shift production, you know, and lower its EV costs. That was a big driver of their guidance that they gave, is coming from lower EV losses. And their 2026 EBIT guidance is coming in way ahead of 2025, and it could go even higher if we get a USMCA resolution. So I think that's really what folks have really focused on.
And Tom, as you mentioned, you know, unemployment relatively low. Consumer confidence, though, isn't great right now. We know that the consumer spending that is happening because of the top income cohorts in the U.S. So what does all of that imply for vehicle purchases this year, and specifically new vehicle purchases this year? As you say, it ain't just EVs, right? You can buy used vehicles generally at a lower price.
Yeah, that's true. But it's interesting if you kind of take a step back, right, and you look at the pandemic, and you look at the years after the pandemic, and you look at things like age of fleet, scrap rates, like how many vehicles are scrapped each year, looking at the past 50 years, and you extrapolate that, right, from pre-pandemic to today, you actually come up with a deficit of cars that were never purchased of about 5 million cars. Each year in the U.S., they buy around 16 million. So there's just a huge amount of cars that were never bought because of the pandemic. And like I said before, this isn't like McDonald's or Chipotle or whatever, right? You have to drive to work. If you have a job in the USA and you have to drive, you have to buy a car. And the age of the vehicle does matter, right? And for GM, they're selling cars more on the kind of upper end of pricing overall. So I think they benefit from this kind of higher end consumer benefiting, and the fact that the car ultimately, I just don't think it's a consumer discretionary purchase.
I mean, I took New Jersey Transit to work today, and I wish I had driven a car, Tom. On another note, for those of us who are relying on transit these days, would you say that GM is I know you have an outperform on a number of names, GM included. Would it be your top pick within the sector right now, or would you point elsewhere?
We really like GM, definitely, but our top pick is actually on the supplier side, especially suppliers levered to GM. One example is American Axle. This is a supplier. They are doing an M&A, a deal with a British company. And there's a lot of synergies there that I think folks don't really appreciate. And they're going to benefit from the volumes that are going to come out this year and all the stuff I've been talking about. So we really like the U.S. supplier space. But yeah, I mean, GM is definitely a story that's going to work out continually. And we do see a tariff resolution as a big catalyst, especially Mexico, that should help the U.S. suppliers and OEMs like GM.
Tom, great to see you. Appreciate it.
You got it.
Talk to me about how Q4 progressed and which sort of leads us into 2026 and GM's projections there. Improved compared to this year, though modestly so.
Yeah, so 25 was quite the adventurous year as we started with a lot of uncertainty around the tariff environment. And as tariffs stabilized, we implemented the plan that we had begun working on as long ago as November of 24. And I think the team did an excellent job of dealing with the adversity and the challenges that the year presented to deliver the results that we did. And that culminated in what I think was a really strong Q4. Picked up a lot of share and continued to see that success. So that turns into the profitability that drives the cash flow engine that allows us to continue to allocate capital in a way that's friendly to shareholders. And I think that topped off what I'm really proud of what the team accomplished in 2025.
So I know that I think CEO Mary Barra wants to return to 8 to 10% EBIT margin there in 2026. You mentioned the tariff exposure, $3.1 billion, I believe, this year, and you're kind of seeing the same next year. Is there any improvement from the White House talking about any kind of improvements there with tariff rates there, or is it still going to be what you think happened this year is going to be the maintain in 2026?
Well, I think when you look at our net tariff exposure, which is our tariffs less our self-help initiatives that we've talked about, we have 3 pillars: go-to-market, footprint changes in manufacturing, and then ultimately fixed cost reductions. We were able to offset more than 40% of our total tariff bill in 2025 by just going to work and figuring out what we do as a GM team. And more of that is going to continue in 2026. So, we're very comforted by the administration in terms of their willingness and to work with the U.S. auto industry. I think they realize how incredibly important it is to the country and to our economic health overall. And I think they've been fair in terms of how we have progressed through this and how they've treated it to make sure that the industry isn't put in a difficult position where it can't compete globally. And I think within that framework, we've been able to cut our own path that I think works well for us. And getting back to 8% margins in 2026 is probably about a year to 18 months ahead of where I think investors thought we would be. So that progression has been really good for us to get back to that range and really do what we do.
That leads me to the $6 billion share authorization plan and the dividend hike as well, concurrently. Are you able to do that, or GM able to do that because of the fact that you have that tariff exposure, sort of, there's more certainty there with that?
So we paused our share repurchases about a year ago as we went through that uncertainty, not knowing what that tariff landscape was. But as soon as we got that certainty, we immediately got back into what we've been doing in that balanced allocation of capital. So we don't see any reason to change that. While valuations have gone up slightly, we're still at a discount to the industry, and we're still one of the most valuable stocks out there in terms of free cash flow yield. So we still have a double-digit free cash flow yield. We feel like the stock is undervalued, and that's why we're able to continue to use our capital and free cash flow to go back and allocate some of that back to shareholders.
So you're generating cash there on the auto business, but then also there's the EV side of the equation is you took a $6 billion hit there in the Q4, I believe, and you might see some hits in 2026 as the business reorient itself. But also, I read that the losses are sliding; they're coming down in that business. How do you turn the tide there? And I know Mary talked about how when people go with EVs, they don't want to turn back. So you have some momentum there. How do you keep it going with EVs with the loss of the tax credit in Q3 of last year?
Well, I think the first thing we had to do, and while it's never great to write off capital, sometimes you just have to do it, and that's where we've kind of hit the reset button. If you think about where we've been for the last few years, we were tooling up and scaling up to produce 1 million EVs a year because that's what the government was requiring under the prior administration. So with the changing regulatory environment, we see a much slower path to EV adoption, but we do see a path. So what this is allowing us to do is to continue to drive cost savings and improvements into the vehicle profitability. What we're doing with the new battery technology coming on in 2028 with LMR, which has all the energy density of high nickel, but at a cost that's more like LFP. It's going to allow us to save thousands of dollars in the vehicle. So we can do that on lower volumes going forward. As far as demand goes, I think it gives us time to get the charging infrastructure up and ultimately get people more accepting of EVs, because when you look at the product offering and what it can do for a consumer with the technological capabilities, et cetera, it can be a superior driving experience. But people are going to have to test that, and we're going to have to get over some of the charging anxiety issues, get more chargers out there, and that's going to continue to drive demand. And I think we can be in a leadership role, especially now that we've reset our capacity to be more efficient going forward, and that will save us thousands of dollars per vehicle going forward and ultimately help us back on our journey towards profitability in EVs.
New Bolt EV coming out, I believe, this year too, at a cheaper price point as well. Does that help you sort of get back to 100,000 EVs a year? Is that possible again, or is it going to be a slower game plan?
Well, I think we'll probably do about 5 to 7% EV adoption. We think that's where the trend lines were before the IRA and the consumer tax credits came into place, and that's kind of where we've settled out. Although it's been a little bit noisy since September, and we expected that. So I think over the next few months we'll get a better idea of where demand is, and I think it'll steadily go up there. When a customer drives an EV, we see about an 80% retention rate where they say that they want an EV for their next vehicle as well. So it's going to take a little bit of time, but we've got the patience, and I think we've got the capital to be able to do it.
I see that 01X behind you, and on the flip side, the powerful V8 engines there. So, I want to talk to you about gas-powered cars, building in America. How do you increase that exposure to the U.S. Manufacturing and still keep costs down? And by the way, you're still seeing a $16 million SAR this year. Is that going to be driving that? Is it all about gas and hybrid cars?
Well, obviously with the regulatory environment, it allows us to sell more of those ICE vehicles that consumers want and demand. And I think we've got a great franchise, all across the board for all price points. Last year, we sold over 700,000 vehicles with a price tag less than $30,000. So it's been an incredible run, and I think our portfolio really speaks to every customer wherever they might be on their price points, and that gives us a leg up, I think, on the industry, and allows us to pick up some share. So that's going to continue. And when you look at driving that cash flow, what it's allowing us to do is reinvest back into America. So we've got about $5 billion of capital that we've allocated to onshore production. And we think by the time we get to 2027, when many of those projects come online, we'll be producing nearly 2 million vehicles a year in the United States.
So the stock up 5-6% here. The call ongoing. I guess investors like what they're hearing about the game plan there. You know, the guidance was a little modest, but I think that given where we are with tariffs and the auto industry in general, I think investors are sort of buying GM's playbook here.
Yeah, and the uncertainty lingers, but they're willing to stay on for the ride, it seems like, quite literally. Thank you, Pras. I appreciate your time.